Ladies and gentlemen, welcome to Woodburn Accountants and Advisors webinar series on what you need to know about accounting and tax in China. Have you created a budget for your China investment? Have you calculated your registered capital correctly? Have you opened up your corporate bank account? Do you know how banking works in China? Have you started issuing VAT, Fapiao invoices? Have you been negotiating your taxes and tax liabilities with your tax bureaus? And have you created your profit repatriation strategies? In this week, we have conducted 3 webinars so far answering the majority of these questions. And today we're going to be looking at the last question, which is, have you created your profit repatriation strategies? For those of you that don't have entities in China, we will also be looking at cross-border payments and how they may affect you if you are invoicing companies in China. But before we begin today's session, I would just like to make sure that we go through a couple of administration sections. As is very typical with webinars, because you are online, if there are any internet instabilities, it could be that we get cut off. It usually does take only about 30 seconds to 1 minute to rejoin, so don't exit the webinar. As soon as we are back up, we will continue with the presentation. In addition, if you have any issues with the audio functions or you have firewall problems, please note that you can use, obviously, your computer audio, tablet audio, etc. Usually that's a poorer connection than if you use a landline. If you want to switch to a landline, then you have to do that in the audio section. Click the telephone button. You'll get a dial-in number, an access code, and an audio pin, and then you will be logged back into the webinar. We will have a 5 to 10 minute Q&A at the end of today's presentation. So please don't be shy. Add comments, add questions into the questions section of the control panel. If they are very much company specific, then I will answer you separately at the end of the session. Today's presentation is being recorded, and a copy of the PowerPoint will be distributed to all registrants and attendees as well. So let's go ahead and test the system. For those of you that are listening in and are able to listen in, could you click on the hand button in your control panel? That will allow me to know that you're listening in. Thank you very much. Great. If you want to unclick the hand button, then you can do so as well. So as mentioned, today's topic is outbound payments from China and developing profit repatriation strategies. Just a little bit about Woodburn. Woodburn Accountants and Advisors, we are specialized 100% in inbound investment into China and Hong Kong. What we do is we help foreign investors with pre-investment advisory, market entry advisory, as well as then the establishment, management, and administration of all the entities we establish on behalf of our clients. All our services are revolved around advisory, whether it's market entry, cross-border, tax optimization, corporate restructuring, and then we do the very typical administration services that most companies don't like to do, which is the ongoing accounting, tax, and payroll services. All of our clients come from around the world. They're all looking to enter into the Asian market, specifically into China and Hong Kong, although they may be looking to go into other Southeast Asian regions as well. The clients we have are pretty much doing everything in China, whether it is manufacturing through third parties, producing themselves, doing domestic sales, selling into China, or exporting from China. And more often now, we are seeing service companies entering the market, whether they're in the healthcare sector, pharmaceutical sector, events sector, etc. So again, a small minor disclaimer. The presentation today is very much a general overview. As I will be highlighting throughout today's presentation, a lot of things have to happen directly with the banks and the tax bureaus in order to get clear and transparent information, but it is an overall view on how things work in terms of cross-border payments and developing strategies. Just so you can put a face to the voice, my name is Christina Kohler-Kalucia. I'm the head of business advisory at Woodburn Accountants and Advisors. I've been in the China corporate services sector since 2003, helping a number of companies going into the market, expanding within the market, as well as selling and merging and acquiring other companies. And last but not least, also companies exiting from the Chinese market. So let's get on with today's agenda. We've got eight main topics that we're going to be looking at. And let's start off with the common concerns that companies have in China in relation to capital and profit. So the first point that I get asked a lot, and I really do mean a lot, is China is China, and what we read in the media concerns us and worries us and makes us anxious that if we do establish an entity there, will we be able to take our money out? All right. Now, the answer is yes. Anywhere in the world, if you set up a company in a jurisdiction, you will be able to take your money out. The question is, how are you going to take your money out? Is it going to be through dividends? Is it going to be through repatriation strategies? You've got to figure that out and see what makes sense for you. But in short, yes, if you do everything transparently and legally, you can take your money out of China. If you're an individual, you can also take your money out of China if you're planning on relocating out of China. There are no issues with taking your money out. There are just stringent regulations and procedures that take place. And obviously then it follows on to the next question, which is regulations change in China constantly. Do you think from one day to the next, I will be prevented from taking my money out? Well, let's face it. What does China aim as a goal, or what does any jurisdiction aim for? It aims that investment capital is kept within the country for further investment and expansion within the country. When we look at the financial crisis, 08, 09, because businesses were doing so well in China, a lot of money had to flow out in order to sustain and maintain subsidiaries around the world. So there was a lot of outflow of capital. Was China happy? No, but due to the international circumstances, it was acceptable. And again, regulations can change, but China is certainly not going to come out with a regulation saying foreign invested companies are not allowed to take their money out. It's not going to happen. It would be detrimental to their image. So in terms of running a business in China, you can do absolutely anything you can do in the Western world. It's just a matter of looking at the procedures and what is required. Which leads me on to the next step, which is, in general, China, anything that you have to do in terms of an application is never easy. And it is true for this. When you want to repatriate funds out, when you want to make payments cross-border, these steps are not easy, okay? And by not easy, I mean it's just very much a lot of paperwork and explanation that goes behind it, okay? And this is where, in this webinar today, we are going to be looking at the practical items involved in terms of doing these types of transfers and what it means and what it takes. And ultimately, all I'm going to say is, as long as you are organized and you have the right and valid documentation, it's not as complex as you think. The next question I get is, can I negotiate with various offices about the documentation needed, the tax rates that are applied? Absolutely. Whether you talk with a bank or whether you talk with your tax officer, it is all a matter of discussion, open communication and dialogue, and then obviously, if you're not happy with what is happening, negotiate. But as I highlighted in yesterday's webinar, choose your battles and decide how far you want to take these negotiations. See whether it's going to be a lost cause and whether you just give up and deal with what it is, or you want to take it up for appeal and move up the ladder in terms of the hierarchy, okay? Now, if the company cannot provide the documentation, am I still able to take the money out? The answer is no, because ultimately, if you cannot provide the documentation, it means you're doing something illegal. That's my mind frame. It means you're doing something completely not transparent. If you cannot produce valid and true documentation in order to be able to verify and justify a transfer that is going abroad, then you shouldn't be doing the transfer in the first place, okay? All documentation should be submitted and it should be true and authentic. And I'm going to be highlighting that sentence throughout today's presentation, okay? The next point is each office, whether it's a government office, whether it's a bank, they all require different documentation. It's stressing me out. Should I give up? Should I close my company? What should I do? Don't give up, okay? Just come to terms with the fact that every government office, as well as every bank, is going to ask you for different documentation. And like I said previously in point 5, if you can't provide the documentation, then it's not a true transfer that you're looking to do, okay? So don't give up, just be patient and create the documentation, making sure it's true and authentic in order to be able to satisfy whatever office that you're dealing with. So as point 7, biggest tip, follow the steps. Well, initially, have open dialogue with whomever you're talking to get it done. Follow the steps, follow the guidelines, and don't fake it. The minute that you fake it, you're going to get caught. So be aware of that. A lot of startups come into China, and because they're so much focused on the day-to-day business, they're not always reflecting on the long-term strategy of the company, which is eventually to become profitable and obviously then repatriate dividends or repatriate funds in other ways. That's the ultimate goal of any company that sets up in China. They want to be profitable. The question is always whether you're going to use those profits for further investment locally, or whether you need those funds to be taken back home to pay out investors. Why is it important to develop strategies as soon as you come into the market? Well, first of all, it aids in repatriating funds out of China so that you are free for use of other forms of investment globally, but also that you are creating then a tax optimized structure. It aids you in developing true and authentic agreements and contracts from the get-go, okay? It's helping you to place thought into developing these authentic agreements and contracts before even a transaction takes place. And it helps you, again, with creating a tax optimized structure. And last but not least, and I think this is so important because, like I said, the first point is, can I get my money out? That as soon as people do make money, they want to take it out. Developing strategies aids you in understanding whether you want to keep funds locally in China or whether you need to take them out for other investments. Nobody is forcing you to take your money out. I just want to emphasize that. You are the decision maker as to whether you want to bring money out of China when you do become profitable or when you need to pay an invoice. You are the decider. Nobody else, not the Chinese government, no one. So as long as you abide by the procedures, you should know that money can be kept in order to grow your business and expand your business in China if needed. If it's obviously needed elsewhere, by all means, repatriate it out. But if it's not, nobody's forcing you to take it out, okay? And this is something that also a lot of companies forget. They feel the pressure that they have to take it out. And when it comes to a period of further expansion and further investment into new product lines, new service lines, into people, they realize they don't have the funds to do it, okay? So again, keep in mind, nobody is forcing you to do it. I added this slide in because there are going to be a lot of people online that don't have entities in China, but are doing cross-border transactions with Chinese companies. Meaning you might be a UK, US, Canadian, German, French, Spanish company, and you are offering services to Chinese companies and you are invoicing for it. Now, this presentation applies to you as well because I'm going to teach you what it means for that Chinese company to approve a contract that you've signed with them and to organize a payment to you and how complex it helps. The whole point of this webinar for you guys is to help you understand the processes, understand how you should be communicating and being patient with your Chinese counterparts. And ultimately, because this does happen, and I've had a couple of people email me this week alone talking to me about these things, it helps you to prevent Chinese counterparts from cheating you, particularly on tax components, okay? So I want you to be aware of those 3 items. and how this presentation will pertain to you. So I didn't actually create a poll. I probably should have, but you know, the biggest question is, do you think the authorities in China are familiar with tax optimized structures? Now, I'll be open with you. In the past, probably until 4 or 5 years ago, the Chinese authorities were not, which meant that if you repatriated funds to Hong Kong, Singapore, Seychelles, Cayman Islands, British Virgin Islands, Isle of Man, Guernsey, Jersey, Cyprus, Malta, any of these types of tax haven jurisdictions, they kind of all went through. And unfortunately, in those days, a lot of repatriation strategies were created around fake agreements, meaning there was no substance behind those agreements. It was one-page documents that once submitted, funds could be freely sent out. As I mentioned during the webinar on banking in China, the world has changed in the last 5, 6 years, okay? Meaning that any transaction going through a bank is going to be scrutinized regardless of the jurisdiction, from where it's going to where it's going to. Chinese tax officers are definitely more familiar now and have been educated on tax optimized structures, which means that anytime you want to get a contract approved for repatriation cross-border, it will be investigated. Now, this is important for those of you that have entities in China that are looking to get repatriation strategies approved, and it is important for those of you that are dealing with Chinese companies and understanding that for any cross-border contract, those contracts are scrutinized to make sure they are real and valid. It is not easy for the Chinese counterpart to get those contracts approved. There's a lot of negotiation that is involved, okay? So please be aware of that when discussing and negotiating with the Chinese tax authorities. They are much, much more educated than they were about 5 years ago. So the answer in short is yes, which means, what does this mean? This means that any cross-border transaction you are going to create, whether it's regarding dividends, repatriation strategies, or just general service transactions, you've got to create true, authentic agreements and contracts that are valid for China. Here I've put the UK because in this presentation I'm using the UK as an example. It can also be with the US, with Germany, which any jurisdiction outside of China. The contracts have to be true and authentic. Be smart. You can't fool the tax authorities, and trust me, the tax authorities are always going to ask for additional evidentiary proof on the agreements, and I'll explain about that later on in the presentation. So don't mess with the tax authorities. Don't think that you can fool them. It's not, it's not going to work. Make sure your overseas company has economic and commercial substance in order to be able to benefit from the double taxation agreements that exist. And again, I'll go through that in more detail later on. And last but not least, this is very critical. Understand that there are Forex issues in China, okay? There are going to be a lot of Chinese companies that you approach that will just say, we cannot transact with overseas companies. And the main reason behind that, if they haven't given you a reason, is the Forex issue, okay? It either means they don't have foreign currency available, or it's going to take a long application for them with the bank in order to be able to exchange. And the higher the value of the invoice, the longer the application procedure is to get that exchange. So for those of you that don't have entities in China and you are looking to transact and get paid from Chinese companies, you should honestly think about opening up renminbi accounts in your home jurisdiction. So talk with Chinese banks that are located in the UK, that are located in Germany, that are located wherever it might be, to see whether you have the ability to open up a renminbi account and how that renminbi account can be of use to you when you are transacting and invoicing with companies in China. All right, I have to start with the basics in order for everybody to understand how it works in terms of developing repatriation strategies, and then obviously doing the cross-border payments. So let's start off with truly the basics, okay? Enterprise income tax, which is profits tax, which I talked about yesterday, it's set at a standard rate of 25%. As I had mentioned yesterday, starting January 1st, 2019, there are special benefits being provided to small, medium-sized companies and startups in China. If you reach a revenue level of less than 1 million RMB, your tax rate will be 5%. If it's between 1 and 3 million RMB, you're looking at a tax rate of 10%. Now, once you are profitable, before you can distribute after-tax profits, foreign invested enterprises are required to make up any losses carried forward from previous years, and it's up to 5 years. Additionally, they are required to allocate a certain rate of the after-tax profit to reserve funds, enterprise development funds, and staff incentive and welfare funds. The reserve funds, they are used to cover any losses that are suffered by the foreign invested enterprise. Enterprise development funds used to expand the operation and increase investment with approval from the MOFCOMs and COC bureaus. The staff incentive and welfare funds are an irregular reward to employees and other collective staff welfare. So for example, allowances to employees for purchasing, constructing, repairing their houses, etc. So it means you have to carry forward any losses, and then you have these funds that you have to open up and put capital into. There are caps. So for WOFIs and for FICEs, you are required to allocate 10% of your after-tax profit to the reserve fund, and you cannot reduce this rate until the fund reaches an amount equivalent to 50% of your registered capital, okay? There is no, for WOFIs and FICEs, there is no development fund and staff incentive welfare fund unless you want there to be. And for joint ventures, there's no minimal or maximum limit. It is decided upon by the board of directors in terms of the ratios for these 3 different funds. All right. So that's a little bit about the funds. And when you are thinking about profit repatriation strategies, and obviously these are transfers that are occurring with sister related companies, you have to think about transfer pricing. Okay. Now, the key point here, and I've highlighted it in red, when you are preparing your local transfer pricing file, you don't have to prepare a file until you've reached any one of these items. Now, for a startup or small, medium-sized company, probably point 4 is where you have to pay the biggest attention, because that will probably be the one trigger point that will occur the first before any of the others, which is doing any related party transactions. If they exceed 40 million RMB, you have to start preparing your local file. I mean, you should be preparing it probably once you hit the 30-35 million mark. All right. So definitely think about transfer pricing. As a rule of thumb, if you are a startup in a small, medium-sized company, you probably don't have to think about transfer pricing regulations and rates and markups so thoroughly in that you have to do a research project or anything like that. But keep it, you know, at common rates. Don't overexceed it. Otherwise, you will get a lot of questions during the transfers. And I'm going to explain what I mean by that in terms of percentages later on in today's presentation. So the next thing that you have to look at when you're developing these repatriation strategies, and I've used the UK as an example, is you've got to look at the double taxation agreement between the UK and China. And ultimately, you've got to look at the last column, which is the new DTA rates. So anytime you develop a repatriation strategy or you are developing a cross-border transaction with a Chinese company, you've got to reflect on that last column, looking at the dividends rates, interest, royalties, and capital gains rates. So for whatever jurisdiction you're in, definitely, whether it's Germany, US, Canada, look at the DTAs that are existing and what rates will apply to you when you start developing these strategies. So again, now I'm going to look at the methods for repatriating funds. For those of you that don't have entities in China, I will highlight to you where you will come into the picture in terms of the cross-border transactions. So the first method of repatriation is obviously the easiest because it is the most transparent, dividend repatriation. What does dividend repatriation mean? It means you have declared and paid profits tax. You have paid all the taxes, which means now you can repatriate the funds. But you cannot repatriate any dividends until all your registered capital has been injected, all prior year's losses have been made up, and the statutory reserve funds have been set aside. Okay? At that point, you can start repatriating dividends, and it is a relatively simple procedure. You don't even have to drop any type of contracts because you already have your audit proof and your annual profits tax filing proof to organize the transfer. Dividend repatriation, if you have the capability of doing it, will occur once all of your annual compliance procedures have been completed. Okay? So the tax considerations that you have to think about if you are a UK-based shareholding company is a 5% withholding tax on the dividends. Now, why is this important? It's because if your UK company is purely a holding entity, meaning that there is no economic and commercial substance within it, the 5% may not apply, which means you have to go with the 10%. All right? And be aware, the larger the value of the repatriation of dividends, the more documents and proof the tax bureau want to see to show that your UK company has economic and commercial substance. Now, historically, a lot of companies have utilized Hong Kong as a holding company jurisdiction for their China subsidiaries. And this is where it becomes a huge issue because these holding companies are doing absolutely nothing. There is no economic and commercial substance in them, which means the 5% withholding tax that exists between the Hong Kong and China DTA will not apply and the full 10% needs to be paid. Okay? Questions that get asked to show proof of economic and commercial substance are things like how many people are on the payroll? Do you have your own office space or are you utilizing a virtual office concept? What type of transactions are running through the company? Can we see the financials to see what is going through the company, etc. These are just basically the three basic ones that do come up though. Now, when you want to go through a dividend repatriation, you have to go through an outbound payment process at the bank. These are all the documents that are required in order to, or these are all the steps, sorry, that have to occur in order to be able to then go to the bank. You have to have completed your annual audit and your annual tax compliance. You need a resolution that's signed by the board of directors to state that profits will be distributed as dividends. You need to do an application with the tax bureau to make sure that you can obtain the DTA benefits, which is where they will look and ask questions about the economic and commercial substance. The tax bureau at that point will want to see the filing of the profits tax return. They, depending on the amount of transaction, so if it is over 50,000 US dollars, you have to do a record filing with the tax bureau. This document will be required. Then you can go off and do the bank payment. At the bank will require an application form, the signed original resolution in original, the audit reports, the annual tax filing return, the tax record filing form that was signed and chopped by the tax bureau, and proof that the registered capital has been paid and that the reserve funds have been allocated. Okay, very thorough. And as I highlighted here, this list has to be verified with the bank. So you need to have open communication with the bank saying, we want to do a dividend repatriation. What documents do you need? What needs to be filled out? All right. Now, the explanation now on service fees and the repatriation of service fees, this section can also be used for any of you overseas companies that are invoicing local Chinese companies. This all applies to you in terms of considerations, in terms of tax, and in terms of bank transfer. Okay, this is the process that your Chinese counterpart, your client basically, has to do. All right, so the first thing that has to occur, and then obviously it's the same process if you're repatriating as service fees. So the first thing you have to do is you have to have a valid and true business reason for implementing the service fee. There has to be economic substance. If you are looking to repatriate funds, the economic substance can fall under, I've put here 4 examples. There are obviously a lot more, but one of them is a marketing service agreement, which means, for example, your UK company is doing the majority of the marketing for the Chinese entity. Then you have a marketing service agreement and money is owed to the UK company. Management service agreement. Several high-level management team members, as well as probably operational people, will be flying on a regular basis to China. All the costs that are incurred for these trips can be paid back to the UK. Technical service agreement. You might have technical people that are going over in order to implement projects, implement products, do after-sales services, to do trainings. This again can be paid back, for example, on an hourly rate or on a day rate to the UK company. Recruitment service agreement. You might have your UK company help you to find and coordinate staff versus doing it in-house. So that fee might have to be paid back to the UK. Again, you know, there are, I mean, these all have to be true and valid agreements. So, you know, in terms of what the tax bureau might ask as proof for marketing service agreements, what marketing projects are they doing? Can we see the advertisements? Can we see the digital marketing that they're doing, etc. Management service, we want to see the passport copies and the stamps from the immigration of all people that have traveled in and out of China that you are asking for the money to be paid back. Technical service agreement, they might want to ask for, again, the passport copies of the technical people coming over, but they may also want to see what type of projects these technical people are doing. Is it true and valid that they are there for a specific project or training? Recruitment service agreement, well, this, I mean, it's just a matter of payroll, right? The minute you add someone on your payroll and you say that the UK has done it, what they might ask for is, you know, what can we see the candidate lists or the last 3 people you interviewed? Did you actually do it? Who did the interviews? Is there email correspondence to prove it? So be aware of that. Now, for those of you that are just doing cross-border service transactions with Chinese companies, those contracts are going to be approved. So don't be surprised if your Chinese counterpart comes back to ask for additional documentation to just get the contract approved. Usually it's easier when it's not sister-related entities. I mean, you are 2 completely separate ownerships and entities, but they may ask for additional documentation as well. Any type of agreement you come up with, you might want to think, especially if it's sister-related, you want to think about your transfer pricing model. All contracts should be in place in Chinese language, so you certainly will want to have a bilingual agreement in place. Tax bureaus and banks usually only take Chinese language contracts. And depending, especially for the technical service agreements, be aware of permanent establishment guidelines. With the UK, for example, you've got a 183-day limit within a calendar year, within the fiscal year, where permanent establishment doesn't come into play. If it's over that timeline, that time period, it will. So be aware of these permanent establishment guidelines. Every jurisdiction within their DTA, you should look at the DTAs because the permanent establishment guidelines differ. All right. In terms of the tax considerations, okay, depending on the type of cross-border transaction that's occurring, as I had highlighted in yesterday's presentation. It could be that the Chinese company can apply for a refund or an exemption. In addition, if the Chinese company is a general VAT taxpayer, 6.8% VAT and surtax will be charged. If you're a small-scale taxpayer, it'll be 3.5% VAT and surtax. And then you've got to look at the double taxation agreement chart, and depending on the type of agreement, look at where you fall in terms of what type of withholding tax will be applicable. All right. Now, the key part about the tax consideration for those of you that don't have an entity in China is that before the remittance can be made by the bank, tax proof has to be shown, which means taxes have to be paid, which means that when you negotiate your agreement, you need to specify who is paying that tax. Is the Chinese party liable to pay that tax and then pay it out of the service income or add on top? Okay. I have gotten a lot of emails today about where some cheeky Chinese companies have played around with this number of 6%, and funnily enough, nothing with the withholding tax, which is sometimes a bit curious. But you will find that some Chinese companies say, oh, you know, I have to pay an additional 17%, and that has to come out of the service fee, and it's by law. I love those sentences. It's not by law, it's a negotiation. Who pays that, okay? If you don't have the knowledge about this, they're going to take advantage of you. So you've got to negotiate who is responsible for this tax amount, because it will have to be paid. Does it come out of the pocket of the Chinese party, or does it come out of the pocket of, for example, the UK party? My recommendation, it should come out of the pocket of the Chinese party. But it's a negotiation point. When you have gotten your contract approved by the tax bureau, you then go to the bank and you start, and the first invoice has been issued. Then you get the contract registration, the contract which has been approved by the tax bureau. The tax bureau will chop it. You provide it to the bank. You've also got to apply for the DTAs that exist. You've got to file for the profits tax, you know, the VAT and the withholding tax. You've got to do a record filing, and you got to do the bank payment as well. Bank payment, they will ask for the service contract, invoice, and any other documents that probably the tax bureau has issued to prove the authenticity that it is a true transaction that is occurring. Now, I haven't put here timelines, but if you are talking about service fees and whatnot, what you want to do if you are in the repatriation strategy phase thinking about this is, as soon as you are established in China, you should think about generating these types of agreements, even though it might be a long time before you do any transfers. Because generally, if it is between sister-related companies, it takes about 6 months to get these contracts approved from the tax bureau. There's a lot of back and forth communication. So get these done as soon as you can. If you are doing just a simple cross-border transaction with a Chinese party, you know, it depends on them, on their proactiveness about getting the contracts approved with the tax bureau, but that could already be a delay of 3 weeks to 1 month to get that approved before you even move to any further step. So the next is looking then at royalty fees. And again, here, it is a matter of creating a contract that is valid and true. So I've put in 2 types of agreements. One is a technology transfer agreement, which is a bit more complicated. The easiest repatriation strategy that you can develop and that you should develop is a trademark licensing agreement. Meaning, everyone has a logo. Everyone has a company name that they will probably want to protect in China. So register your trademark before you even set foot in China. You can have your overseas entity owning that trademark. And if China is going to utilize your trademark, then they owe you a fee for it. It's the simplest repatriation method. It actually even only requires a one-page contract together with the trademark licensing certificate, which has been approved. Honestly, you have your key there for your first repatriation strategy, but you need to register your trademark. And this is where that's the biggest downfall for most companies. They register their trademarks at the last moment, probably find out it's been stolen or squatted or taken from another party, and they can't even develop this type of contract or agreement in order to get funds out of China. But if you are looking at developing repatriating strategies, trademark licenses, most valid, true, authentic agreement, easy approval processes, and the most easiest way to get money out, either on a quarterly basis or on an annual basis. Obviously, you have to think about transfer pricing models when you're creating these types of licensing agreements. And again, contracts should be put in place in Chinese. Tax considerations, again, you've got to think about withholding tax rates. So with the UK, it will be about 6%. In other countries, it might be between 5 to 10%, depending on the jurisdiction that you're in. There's going to be VAT surtax. And it's, again, VAT can be refunded or exempted, but generally it's if it's more related to research and development. Okay. What is the outbound payment process application at the tax bureau? The contracts have to be registered with the tax bureau. Supplemental proof needs to be provided with each contract. So for the trademark, they will want to see the trademark license, the trademark certificate that it has been registered in China. They will want to see who owns it, and no contract, the contract has to be with the owner of that trademark. What happened a lot in the past was companies would register their trademarks in their home jurisdiction. So they'd have an entity, let's say in Europe, that holds all trademark registrations, but then they would have this Hong Kong holding company. And they would say, you know what, for trademarks, I'm going to have Hong Kong invoice. And in the past, nobody asked for additional proof. So it was feasible, it was possible. Now, they're going to ask for the certificate. So you got to make sure you have it. You have to apply for the DTA benefits with the tax bureau to make sure that, and that's all part of the contract registration step. You're going to have to file the taxes when the first invoice comes in, and then you can go off and do the bank payment. You're going to see everywhere this $50,000 US limit, and this is something that I had highlighted in yesterday's presentation for cross-border transfers. Any invoice that is over $50,000 US, generally speaking, you need to get a SAFE approval, the State Administration of Foreign Exchange. So you may want to split out invoices into smaller amounts so you don't have to go through that step, because it can make things a lot longer. Well, here for the royalty fees, I've actually put in the contract registration process and what's needed by the tax bureau. So you have the application form, the contract, the business license of the Chinese entity, registration certificate or business license of the shareholding or sister company, how commissions and fees are calculated. So when you're looking at marketing agreements, technical service agreements, any form of agreement, you will have to explain how your calculations are calculated. When you say that it's $800 US per man day, how have you come out with $800 US? If you say an hourly rate of $50 US, how have you come out with $50 US? Have you done a benchmarking? They will probably come out to want to see your formulas on that. They will want to see your latest audit reports, and then again, for trademarks, they will want to see the certificates of registration. Now, there are many other ways of repatriating funds out of China. One is capital reduction, which is something I don't advise. It's an extremely difficult process to go through, and you should have been extremely profitable in order to be able to do this reduction. What it basically means is that you've designated a certain amount of registered capital. You have the term of validity to inject that registered capital. It could be after 5 years, you've only injected 50% of it because you've been so profitable, and you realize you don't need to have more investment capital. You're doing well enough locally to maintain your business and expand your business. And as a consequence, you want to reduce. It is a hefty procedure because the Chinese government, the higher the investment capitals they get, the happier they are, obviously. You can obviously repatriate funds by acquiring assets overseas, offering loans to overseas shareholders or sister companies. You can do adjustments to your transfer pricing models in order to get more funds out. And obviously you can also do offshore investments. Now, probably a lot of you are laughing with the last point, which is why would you use your Chinese company to do offshore investments? This happened a lot during the financial crisis because the funds were in China. So it did happen, which is why I've added it here. It's probably something that is not so common anymore in terms of doing these offshore investments. Now, one thing that I have 2 more slides to go on for today's presentation. And I think one of the most important slides is looking at, what are suspicious signs for the tax authority, what are trigger points for the tax authorities to think that maybe you are doing tax evasion or avoiding taxes. So I've listed a couple of points here, and probably the most significant one is the first one, which is you have significant amounts or numerous types of related party transactions. So, you have to do things realistically. And again, people were doing this in the past because they were scared to keep their funds in China. But, you have to make things, you have to use common sense when you're doing these types of transactions, and you don't want to trigger any suspicion from the tax authorities because, like I mentioned yesterday, there are more and more tax audits that are going on. So not only related to VAT issues, but also related to things like this, which is related party transactions. If you've got, the second point is also critical. So my rule of thumb is, and this is again the trend that I've seen over the last 15 years, when a company goes into China, this could be a startup, it could be, an existing entity, a multinational, you are starting up in China. So, it's going to take time to build up your business. And the tax authorities know that, okay? It's common sense that it's going to take time to build up your business and start becoming profitable and whatnot. Now, generally speaking, until a company breaks even, we're looking at a term of between 3 to 5 years, which means if you are doing better than expected within that first 3 to 5 years time frame, utilize your repatriation strategies already then to get money out before you are declaring the profits tax, because this is the period where it's okay for the tax authorities that you're not profitable. However, if in the next 5 years, so the period between year 5 and year 10, you're still not profitable, this is a huge trigger point, and questions will arise. Now, if the truth is you're not profitable because business is not good, well, you just have to show proof of that. But usually if business is not good, you're not going to be doing a lot of related party transactions cross-border, okay? So think about not only your short-term strategy, but also your long-term strategy. And this is why I say a lot of companies do better than expected in their first 5 years. So think from day one about developing these repatriation strategies, getting these contracts secured and approved so that when it comes time to start issuing these invoices to get funds out, they're readily there and available. If you're doing below average profitability than your own industry standards, or profits don't match the company's functions, then that's also another trigger point. So transfer pricing is becoming more and more popular, which also means that benchmarking studies are becoming more and more popular within the tax authorities. Are they true and valid? Yeah, that's a huge question mark in the transfer pricing world. I'm not going to go into that today because I'm not a transfer pricing expert, but yeah, I mean, it's a question whether these reports are really valid and, are China-based. But they're using these reports as guidelines. And obviously, if you're in an industry or sector that it just looks weird that you're not profitable yet, then questions will arise. All right. If you are doing business dealings with tax havens, so if, for example, the related party transactions are only occurring with tax haven jurisdictions where you might have companies, yeah, I mean, that's a big red question mark there. What are you doing? The UK is not considered a tax haven because there are a lot of operational businesses there. But in places like, and Hong Kong and Singapore are also very similar to the UK on that. But this is where questions like, we want to know their economic and commercial substance. Is there substance behind these entities that you're sending funds to? or that you're transacting to. If you hit any of those trigger points in terms of that I had highlighted on the transfer on developing your local file for transfer pricing, if you have incomplete transfer pricing documentation, that is going to be also a huge question mark. So use those trigger points that I highlighted on these slides to give you a time frame of when transfer pricing needs to come into play for your own organization. And obviously that leads on to violations of arm's length principles as well. So what are the tips to get your strategy set up on time? The first tip is create true, authentic agreements. Don't fake anything. The second is be smart and choose your battles, whether it's with the tax bureau, the bank, or any other government bureau. In these situations, it would probably be the State Administration of Foreign Exchange. Don't fight everything. Conduct the contract registrations as soon as possible with the various authorities that you need to before the first remittances have to take place, okay? Apply to the tax authorities at the same time as the contract registration for the tax assessments. So looking at the double taxation agreements and whether they will then apply to you. And if additional documentation has to be provided for this tax assessment, making sure that, you know, the UK entity, for example, can provide them. Apply for treaty benefits and understand at the bank what is required in terms of documentation as well. Now, for all of you that don't have entities in China, but you're transacting with companies in China, this is what the Chinese company has to go through. So don't get so frustrated and impatient with them. There's a lot that they have to go to in order to get transfers brought out. And it is very, very time consuming. And this is probably also why, together with the Forex issue, you will find that a lot of companies, particularly smaller ones in China, will just say, we won't do business with you because we don't want to go through these steps and we don't have the internal resources to go through these applications. Could very well be. So definitely take that in mind if a company in China rejects a bid or an offer from you, because it's not just the Forex reason, it's also these reasons that apply here. All right, so there are a couple of questions that have come in that are quite client specific. So let me first go through some general questions to kind of sum up today's presentation and end also today's webinar series. So when you're looking at developing or doing cross-border transactions, particularly overseas to China, meaning the contract is from overseas to China and invoice is from overseas to China, be respectful of what people are doing in China. If you don't want to lose out on the business, one of the things that you can definitely do is work with a company that offers you re-invoicing services, meaning a kind of intermediary agent that can do the local transaction, but then also repatriate funds back to you. And obviously they'll do it for a commission or for a service fee as well. So there are re-invoicing agents that are there that can help you so that you don't lose out on any of the China business that you want to grow. And I completely understand it. Many companies are reluctant in terms of setting up an entity or doing an investment in China until they start going through these transactions and knowing what type of business they could generate. So these first transactions are also very vital to know what the Chinese market is. It's a test run, basically. So try to think about using re-invoicing agents as an opportunity or potential. Another aspect to think about with these cross-border payments or these repatriation strategies is something that I highlighted also yesterday. Talk to your tax officer as well as your bank, okay? And if it's not you, your outsourced private provider should be doing it. You need to constantly get the updated information as to the document list for both parties, okay? Because the document list will change. It will never be the same. And I can tell you also now, it will never be the same for the same transaction, for the same invoice. It's frustrating, I know, but you might have the same contract, two different invoice, one invoice in January, another invoice in April, and for both those procedures to get the money out, the tax bureau and the bank will ask for differing documentation. So for every outbound transfer, talk to your tax bureau officer as well as your bank to know what the document list and get updated on it so you can get the documents prepared in time to do the transfer. So I think I'm going to leave it there. There are 2 people that have written questions in. I'm going to be answering you separately because it is quite specific, and I'll refer back to you directly. For the rest of you, thank you all so much for joining our webinar series today. On the first day, we were talking about budgeting. On the second day, we were talking about the practicalities of banking in China. Yesterday, we talked about the new profits tax regulations, as well as looking at VAT invoicing, and how that all works. And today, obviously, we were looking at cross-border payments and repatriation strategies. I hope this webinar was useful to you. I'm always looking for feedback on the webinars, so if you do have time, please email me what your thoughts were on the topics, if something else should have been added, and if you like to hear anything else in the future. If you're happy, subscribe to our free social media sites or newsletters so you can get updated. And last but not least, in October, we're going to have another webinar series on market entry into China, where we are going to be talking about the importance of market research, about not setting up an entity in China. How can you do it by doing business in China? We're going to be looking at rep offices. We're going to be looking at setting up an actual entity. And then we're going to have a guest speaker come in on the Friday about converting opportunities to sales, particularly when you're in this market research pre-investment stage. So if that interests you, go to our website, go to the events section, and you can already register for these webinars that are up and coming. I will be sending out an e-campaign on Monday highlighting this as well. I want to thank everyone for joining me this week, particularly those of you that attended all 4 days. It's wonderful to see people joining every day. And I hope to see you all for our next webinar series. Thank you very much, and goodbye.